Good afternoon and welcome to our Learn at Lunch webinar series. This webinar is part of a grant from the Farm Service Agency. And for more information on today's topic, visit the eFarm Management Training website. If you have questions, please enter them into the chat box in the lower right corner and they'll be answered at the end of the webinar. Today's speakers, Trent Malachek and Dr. Rodney Jones, will discuss the basics of crop insurance. Now, I'll turn it over to you, Dr. Jones.
Thank you, Brent. The reason we wanted to visit with you a little bit today is because the crop insurance decision has always been a little bit complex, but it's becoming more and more complex for a number of reasons, partly because of the commodity price environment that we're in and the very tight margins, partly because of some interactions between some crop insurance products and farm program selections that were made a few years ago. And the bottom line is that we're in changing times, and products that were a good fit 3 or 4 years ago during times of higher prices might not be the most appropriate decision for a particular producer today. We might see instances where we have producers who have more coverage and are paying for more coverage than they need. That's pretty rare. More commonly, we may see producers that now find themselves with less coverage than they need. For example, I worked with a friend of ours in our local community just a few days ago to make sure whether or not they had an insurance claim on their canola crop, and it turns out that even though they had relatively low yields on their particular farm, they did not trigger an insurance claim because they had a very low level of coverage, and they were quite disappointed to find out that even though their crop didn't come anywhere close to covering their costs of production, they weren't going to get any help from insurance. In other instances, we may have folks that have a high level of coverage, but could find some ways to lessen the cost of that coverage through some creative use of some other products and some other alternatives. To start off with, most of you are fairly aware of the basics of crop insurance, but the most common products that we have in Oklahoma and most closely surrounding areas are the revenue protection products, for which losses are calculated based on that combination of yield times price. So a loss or an insurance payment could be triggered by either a dramatic drop in price or a yield shortfall or some combination of the two. And we have the basic yield protection products where losses are calculated basically based on a yield shortfall. We also have the NAP products, which Trent's going to talk about here in just a few minutes. They're basically available for commodities for which these other traditional, I will call them, crop insurance products are not available. There are a few, in some cases, other products available that you could purchase in Oklahoma, some whole farm revenue type products. They're not appropriate in very many situations, but never say never. So we simply don't have time to talk about them in any degree of detail today. We will try to get some basic resources assembled and put on the website to help people make those decisions if in fact some of those products that are less commonly sold in Oklahoma happen to be appropriate for your particular situation. Basically, we're going to be talking about the revenue product and the yield product and the NAP product here today. So if for most of our commodities we have two choices, revenue and yield, that sounds pretty simple. But it's really not that simple, because for either the revenue products or the yield products, producers can choose coverage levels, in many cases ranging all the way from 50 up to 85% in increments of 5 percentage point jumps. I will mention 85% coverage is not available for all crops in all locations. The most common choices that I think we see for most Oklahoma producers fall in that range of 60% to 75%. 65%'s been common for many producers. A lot of producers like to bump that coverage up to 70 or 75, or in some cases even 80%. Just a few points about coverage levels, just in case you don't already know some of this basic information. The premiums are lower to begin with for lower percentage coverage levels. For example, the premium for a 60% policy for either revenue or yield protection would be lower than it would be for a 75% coverage policy. And in addition to that, those premiums are subsidized at a higher level at the lower percentage coverage level choices, which means basically that the farmer paid cost is much lower for the lower coverage levels. However, there's a trade-off there. You're not getting anywhere nearly as much insurance coverage, as my friend found out just a few days ago. Another point to keep in mind is all else equal, coverage levels equal, proven yields equal, etc. Premiums are higher for the revenue product than they are for the yield product, because you're purchasing a little more coverage with that particular type of product. You're insuring against another type of loss. To further complicate things, revenue producers can choose to, product purchasers can choose to have their loss calculation based on only the planting time price projection, which would be the harvest price exclusion option, or they can choose to have their loss calculation based on the higher of the planting time price projection or the actual harvest time price for the particular crop that they're buying insurance for. We would call that the harvest price option. Of course, all else equal, the harvest price option adds to the cost of the insurance. The premiums are going to be higher because, of course, you're buying more insurance coverage. You're basically buying some commodity price options along with the insurance coverage. So that complicates the decision just a little bit more. To further complicate things, producers can choose to have their loss calculations based on basic crop insurance units. And without going into a lot of detail, that means each geographical section for each crop is its own insurance unit, as long as it's under the same land tenure arrangement. For example, if you own land in two different geographical sections and you plant wheat on both of those fields, each one of them is treated separately for insurance purposes if you insure them using basic unit crop insurance. Or you can choose to purchase crop insurance based on what is known as enterprise units, where for a particular producer, all the fields of that particular crop are averaged for loss calculations. So if I have some wheat in 4 or 5 different sections, I have 4 or 5 different fields of wheat scattered geographically across 4 or 5 different geographical sections. I could have good yields on 2 or 3 and a significant yield loss on maybe 1 or 2, and I wouldn't get an insurance payment because the good yields would average out, so to speak, the lower yields. So what makes this decision fairly complicated is, all else equal, enterprise unit coverage premiums are lower to begin with, and in addition are subsidized at a significantly higher level. So the portion of that premium that the actual farmer pays is much lower for quote unquote the same level of coverage. However, the type of loss being covered is much different with the two different products. With enterprise units, you're insuring basically all of your wheat. With basic units, you're insuring each individual field, or at least each individual section, operated under the same land tenure arrangement. So quite a few differences there that all make the crop insurance decision much more complicated. Most of you have seen the subsidy levels between the two products, but just in case you haven't, just to illustrate the difference between the subsidy levels of the two different types of insurance products. The basic unit coverage, or we will call that optional unit coverage, say for example at the 65% coverage level, which is a common product that is purchased, the taxpayers, somebody else, pays 59% of your crop insurance premium for that product. If you were to move over to enterprise unit coverage at the same coverage level, the 65% level, the taxpayers, i.e. somebody else, pays 80% of the total premium. So quite a difference in the subsidy level, not to mention that there may be differences in the underlying premiums to begin with. So enterprise units lessen the cost of crop insurance quite a bit, but bear in mind you are not getting exactly the same coverage level. To further complicate the crop insurance decision, there's an additional product out there that became available with the most recent Farm Bill that basically sits on top of your underlying basic insurance product called Supplemental Coverage Option Insurance. And it basically takes whatever level of underlying revenue protection or yield protection coverage that you have chosen. It takes that level from whatever it is, let's say 65%, up to 86%. Now there are some nuances that make it such that that's not a 100% technically correct statement, but basically that's what happens. The supplemental coverage option insurance is, however, based on county loss calculations rather than your individual field or your individual farming operation for the whole crop for your farming operation. What makes the supplemental coverage option somewhat attractive is that the premiums are relatively cheap and relatively heavily subsidized. So it's an inexpensive way to achieve a higher level of insurance coverage. The kicker here is it's not available for crops planted on on base acres that are enrolled in the ARC program. So for example, if all your base acres are wheat and you have those base acres enrolled in the ARC program, then you cannot get supplemental coverage option insurance for your wheat. You could get supplemental coverage option insurance for other crops for which you don't have base acres enrolled in the ARC program. Since a lot of Oklahoma producers have wheat base, and since a lot of that wheat base in Oklahoma was enrolled in the ARC program rather than the PLC program, there's a lot of wheat planted in Oklahoma that's not eligible to purchase supplemental coverage option crop insurance. So all of these things make the crop insurance choice very complex. Producers have to choose from the possible coverage level, unit structure, choices, and make a choice as to whether they want to add SCO, if in fact they can add SCO. And if you figure up all of the possible choices that might be available to a particular producer, there are literally hundreds, if not thousands, and the producer has to pick the appropriate crop insurance product for their situation for that particular year. Now, why this is relevant today and why we're having this webinar today is because deadlines are approaching for some of the crops that we plant in Oklahoma, as many of you may know. August 31 is the deadline for canola. We're actually tracking the planting time price projection right now for canola, so we're getting very close to decision time for canola insurance. It's about a month later, September 30th, for most of our other fall planted crops, and the deadline comes up in March for the spring planted crops, so we may have to do another little reminder webinar as we approach spring planted crop sign up deadlines. And as conditions change, prices, production plans, etc., it may be appropriate to consider doing something different than you did last year or than you've done for many, many years in the past. A common issue that we see is that producers may need to consider finding a way to achieve a little higher level of coverage than they had to have several years ago when commodity prices were higher, just so that they can be ensured that they can make their loan payments, for example. I know we have a lot of lenders on the webinar or listening to the webinar at a later date. So a concern for both our producers and our lenders is, can the producer make their payments? And it may take a higher level of coverage today to be able to make those payments in a poor crop year than it did just a few short years ago. I'm going to turn it over to Trent for the next few slides to talk about setting the stage for making the crop insurance decision.
All right, thank you, Rod. Yeah, you talked about a lot of complicating things, and I guess I'll spend a few slides here talking about things you may know or good questions to ask the people you're trying to help make these decisions. And we start with laying the groundwork. We talked a little bit about canola, but I'm going to focus more on wheat and cattle because that's what a lot of our producers are going to be looking at here in the near future. So identify what type of producer you are. Are you just a wheat grain farmer? Are you going to just be grazing off that wheat with cattle? Or are you going to do some combination of both? And this is all about trying to identify what the risks are of your operation. Are you going to be open to both price risk on the grain side and production risk, which most of our producers are going to be open to both of those unless they've done some kind of price protection in the futures market? Or can you offset some of that risk from the grain prices and grain production with cattle, but that also entails several other sets of risk, whether it's cattle price risk or cattle production risk. So identifying what type of producer you're dealing with is very important, because if they're a grain only farmer, crop insurance is going to be the basis of their risk management strategy, and all of their profits will hinge on the amount of production that they can produce off of those acres. And then you try to gather some information about that producer. What risk management strategies do they already have in place? And we come to the next bulletin, are base acres enrolled in either ARC or PLC? This is the big risk management program that the government is offering our producers, and you can kind of try to figure out, if they're in ARC, they're in a revenue-based protection or risk management program, and if they're in PLC, they have most of their or some of their price risk protected there. So it's going to be important to decide what type of government program assistance they're going to receive to figure out what coverage levels and what type of crop insurance is going to be good for those individuals. And then you can start by asking yourself or your clients, do you have a significant amount of acres that are not covered by base acres? Because we know that those FSA programs pay on base acres, and if you have a particular producer that is growing wheat or other crops on farmland that either doesn't have base acres tied to it, or you come to the next bullet point, if they're planting crops that are different than what the base acres are enrolled in at the FSA office. If they have base acres in milo or corn and they're planting wheat, obviously their risk protection is going to be on a crop other than what they're planting. So they may need a higher level of crop insurance coverage to protect that particular crop if they're receiving risk management assistance on some other crop through the FSA. And then it all comes down to what their risk exposure is, and then maybe some of our young producers or some producers who are just getting started, if they have a high debt to equity ratio, because then we know if we're dealing with a producer like that, that they are going to need higher levels of insurance coverage because of their cash flow positions and the fact that they have a lot of risk out there with each crop. They can't absorb these losses that some of the more established producers or producers with a large cash position can't absorb without some crop insurance protection. So these are all things that we have to kind of information we have to gather before we can start making an educated decision on what type of crop insurance we're going to need. And then you can look at that variable cost of production as that last bullet point. If they're a high cost producer, their needs are going to be much different than producers that are able to produce this crop, below average cost. So determining your coverage requirement, this decision, as hopefully I made clear on the first slide, is going to be very dependent or different from producer to producer. Just like no farmer is the same, no crop insurance decision is going to be the same. You could have two different producers both producing the same crop, but they will both have very different perceptions of risk and different needs associated with their risk management strategy. And a lot of that comes from the amount of fixed and variable cost in the operation. Some established producers, if they aren't needing a lot of return on their land and they're just concerned with covering variable costs, their needs are very different than a producer that maybe has money borrowed on land and also has a high variable cost of production. And as we look at a budget here in the next few slides, it's going to be evident that there's not a lot of winning decisions here. We're just talking about trying to minimize catastrophic losses with the price of wheat and our expected yields. High fixed costs include, whether they have a new machinery complement or a fairly new machinery complement, that could make their fixed costs high. Again, owned land that is mortgaged or is not paid off completely. And then, of course, you can look at high cash rents. If they were able to obtain land over the last several years by bidding up cash rents, then the current price situation we find ourselves in doesn't bode well for high cash rents. And then high variable costs could arise from low soil fertility or weed pressure. If you took on some new farms and you're trying to clean up a mess that another farmer was dealing with, or if you find yourself in a situation where you're having to work ground more than average, then of course your variable costs are going to be quite a bit higher. So making the crop insurance decision, we'll start off with a wheat budget. This is a budget from last year, but I think not much has changed. We're hopefully we can adjust that wheat price up just a little bit as we move through 2017, but our rally has come and gone and we're still looking at pretty low wheat prices. But if we take an average yield of 32 bushels per acre for pretty much the whole north central region of the state, and we sell that wheat for $4 a bushel, we're only generating $128 worth of revenue. And this is where we start getting concerned about the ability to cover our variable cost of production if we're only producing grain, because a 32 bushel wheat crop and then you trying to pay off those associated variable costs of production, you can see that this budget comes in at a profit of negative $47 per acre. But even if you find a producer in this situation, whether they need to be planting wheat or not is another question altogether. But we definitely have to think about, even though we're losing money on this crop, risk protection is still very important, because we need to know what our exposure is, and if we're looking at maybe coming under our total variable cost, how can we limit the downside there if we have a bad price situation or a loss in production, how we can minimize our risk exposure and how much price decline we can absorb in our operations before we're looking at a situation where we could be going out of business. So how much coverage do you need? Budgets are showing losses at average production and prices, and like I said, you can adjust that per the producer, because no two producers are going to be the same, and our variable cost of production are going to be different. But I think this all bodes well for what Rodney was saying earlier, and the fact that we're going to be looking at high levels of insurance coverage to try to cover our risk. And even then, at the highest levels, we probably aren't going to be covering all of our costs in a bad year. So figuring out the debt to equity position, knowing what people or what your producers or yourself can absorb is going to be very important when it comes to making these decisions. Figuring out what type of assistance you're getting from FSA programs all tie into this decision process. Here, I'll hand it back over to Dr. Jones.
Thank you, Trent. I want to talk just a little bit more about the revenue insurance product. Prices are set at different times of the year depending on what crop you're talking about. The planting time prices for our fall planted crops are for both the revenue products and the yield products, for that matter, are being set kind of right now. But the harvest time prices are going to be set during the time period that we typically would harvest and market that crop. So, for example, right now we're tracking the canola planting time price from about mid-July till about mid-August, and it looks like the canola planting time price, at least as of the last couple of days, looks like it'll be about $9.30 to $9.40 a bushel. We'll begin tracking, not we, but RMA will begin tracking the planting time wheat price beginning August 15th and all the way up through mid-September. And again, harvest time price tracking depends on the month that the crops are typically harvested for. So, for example, for canola and wheat, that's going to be in that June time period. The revenue insurance product allows a producer to lock in revenue instead of just yield, so that if prices collapse, we get a little bit of help from our crop insurance product potentially to help cushion that blow. We get the question a lot, just as people are trying to find ways to lower costs, cut costs anywhere they can. We often get the question, do we really need to incur the extra expense to buy that harvest price option along with our revenue insurance product? And I guess that boils down to the question of, what do you think the upside price risk is in any given year? And some people use a rule of thumb that they elect to exclude the harvest price option, in other words, cheapen up that revenue insurance product a little bit, when planting time prices are at historically high levels. And the logic there is, of course, that if prices are at historically high levels, then there's not a whole lot of risk that prices are going to go higher by harvest time, and we're going to reduce that premium a little bit by not having to pay for that price insurance option in our insurance product. Another logical thought process could be, well, the harvest time price is good enough. Maybe it's not at historically high levels, but it's at relatively high levels, and it's good enough to protect me if we have a loss, and so I'm not going to incur the extra money to buy that harvest price option. How are you going to feel if you don't purchase the harvest price option and then prices go up and you have a loss, and you're not able to collect on that higher price movement because you had a loss and you only get paid at the planting time price rather than, in this hypothetical situation, the higher harvest time price? So a lot of this kind of boils down to your level of risk aversion, how you think about risk, how bad events make you feel. How are you going to feel if you don't purchase that particular product and then something bad happens? I will mention that right now, as Trent mentioned, we had a little price rally and now we've given most of that up. And it's certainly safe to say that prices are not at historically high levels. They're not even at long or short-term average levels. So I suspect that there's going to be very few people out there who would want to purchase the revenue insurance product and leave off the harvest price option, because we don't want to miss out if somewhere in the world we have a crop shortfall of some type and commodity prices rally between now and harvest time. But maybe next year the story will be different. So there's the logic, that the thought process that people go through when they're trying to decide whether they want to spend that extra premium money and go ahead and buy the harvest price option. Yield protection just protects against losses and yield in yield. It's really more suitable for individuals who don't think prices will change much between now and harvest. It may be a way to keep your premiums a little lower, but also know that yields above the guarantee don't always guarantee that variable costs of production are going to be covered, and know that there is a risk that those prices could change and it will not trigger an insurance payment. So yield protection, common product that a lot of people use. But if you are thinking about just using the yield protection product, just understand that you're probably doing that as a strategy to keep your premiums lower and taking a risk that there could be a price movement that would otherwise result in you achieving an insurance payment. But if you don't have the revenue protection product, you're not going to get that insurance payment if you only have the yield protection product, and it's prices that cause your shortfall. I'm going to turn it back over to Trent for a few slides to talk about just some example premiums from not from recent times, but they haven't changed much since these slides were put together.
Yeah, these are just examples of revenue protection insurance on wheat that a producer might find if they go to their crop insurance agent and ask for a quote for these different products. So we show this just to kind of give you an idea of what things are costing. You know, this is revenue insurance optional units, or as we talked about basic units earlier in the presentation. And we have the different crop insurance levels over here. So we have 50% coverage level, 55, 60, and so on, all the way up to 85% coverage level. And this is what we were talking about with the price tracking, or the price that we're going to be tracking here relatively quickly at this $5.20. So this is the revenue price that we're protecting, and then we have the approved yield, which is going to be different for every producer depending on what their yield history is on that farm. So we start building what this crop insurance coverage is going to be. We have a 34 bushel yield, $5.20 price, and then at this coverage level, the 50% coverage level, we are guaranteeing 17 bushels. So if we have a loss in production below 17 bushels with a relatively stable price, that could trigger a payment. But since it's revenue protection, we're not really just talking about protecting yield like we would with yield protection. So we come over and we have a calculation of the guaranteed dollars per acre. So this is the revenue that's being protected with this crop insurance policy, which is probably more important in the grand scheme of things than just worrying about yield or price. Is really how much money am I going to have to pay bills at the end of the year. So we at a 50% coverage level in this example, we're receiving $88.40. We can jump up to maybe a more popular coverage level at 70%. Our yield coverage jumps up to $23 or 23.8 bushels, and the guarantee in dollars per acre is $123.76. So that's kind of what we're working with these crop insurance policies. We have the base premium in dollars per acre of $18.76. So if it was unsubsidized, this would be what the farmer would be paying for that coverage level. Then we come over to the subsidized premium in dollars per acre, and this is the actual price that the farmer would be paying at $9.33 per acre for that coverage, for that $123 worth of coverage. You can kind of see how that subsidy is broken down here, where our base premium at the 50% coverage level is $8.52, but the farmer paid premium is $3.55, so it's heavily subsidized. And then we come up here to these higher levels of coverage, where we see that at 85%, the price to the farmer would be $30, whereas the subsidized premium is $22.25. So we find kind of a break in the coverage levels, and where farmers can feel comfortable, and sometimes that falls at 65 or 70%, but it really just depends on the producer and how much coverage they need. From this example, if we have an approved yield of 34 bushels under basic units, the most revenue that this farmer could purchase, or revenue protection this farmer could purchase, would be $150 per acre. So then I'll jump over to the next slide, which is going to be the same information except for enterprise units. And we've already heard the differences between optional units and enterprise units. But enterprise units tend to be more or highly subsidized or a higher level than revenue protection. So we can purchase maybe a higher level of coverage for the same price. And we saw that 70% coverage level in optional units was around $9. In enterprise units, we can get all the way up to 80% coverage level before we see the same price or the same, roughly the same dollars per acre. So you can see from these two examples how moving to enterprise units, you spread out your risk over more acres. Maybe you reduce the chance of collecting a premium or an indemnity on a certain acre or a certain farm because you're spreading risk over more acres, but it drastically reduces the cost of that insurance, and you can move up your coverage level and secure a higher revenue and be able to cover more of those costs, since times are very difficult for producers and we're needing higher levels of coverage. So I'll turn it back over to Dr. Jones, and then I'll finish up with Nap.
I guess it would help if I turned my mic on before I start talking. As Trent was just demonstrating with the discussion of how those premiums are calculated and how they're subsidized and how those things kind of change depending on coverage level or depending on unit structure, one of the things that jumped out of those previous couple of slides is, of course, the fact that enterprise unit farmer paid premiums for any particular level of coverage are dramatically less than basic unit premiums, which is one strategy that some producers use to achieve a much higher level of coverage for a lower overall premium cost. However, the thing that you have to keep in mind is it's not exactly the same coverage under enterprise units as it is under basic units. The producer and the lender and the insurance agent all have to fully agree and fully understand that you can have a complete disaster on one or more individual fields and still not collect a crop insurance indemnity payment if the other fields of that crop do well. Some people just hate that. I've heard people who've tried enterprise units and had a loss on one field, and they were just really irritated or ticked off that didn't generate an insurance payment. And the reason it didn't generate an insurance payment is because they only had one field that did poorly and 2 or 3 or 4 or however many other fields that did quite well, and of course it all averaged out. Other people just love enterprise units primarily because of the fact that it dramatically lowers the premium, the cost per dollar of insurance, therefore allowing you to bump up total insurance coverage for a much lower overall premium. So some producers wouldn't have it any other way. I happen to be one of those producers. The question you have to ask yourself is, do you think in terms of insuring the whole crop that you're planting, your entire wheat crop or your entire corn crop or grain sorghum crop, or do you just are you just caught up in thinking in terms of insuring each individual field, or technically each individual section that you have that particular crop planted on? So one strategy that some people can use is using enterprise units, but you just have to be aware that it's not the same type of coverage as basic unit coverage. And then what about using the supplemental coverage option as a strategy to get a higher level of coverage, basically bump it up to about 86% with a highly subsidized premium on at least the top portion of that insurance coverage. So a strategy to gain a higher level of coverage for a lower farmer paid premium. Remember again, it's not exactly the same coverage. You can have a farm loss, but if there's no loss at the county level, you don't collect on the SCO portion of your insurance product. So you have to think about how likely is that to happen. How often do I have a loss on my farm, but the county for that particular crop does not suffer much of a loss? We had that kind of happen in Garfield County last year. The northern part of the county raised a pretty good corn crop. The southern part of the county, where I happen to farm, just missed out on every rain through the month of June, and we didn't raise a very good corn crop. It did turn out that the county average was low enough that it triggered an SCO payment, and I don't remember what it was, but it was something like $6 or $7 an acre. But we had a much more substantial loss than that on our farm. So that can happen. On the other hand, it can go the other way. You might have a very good crop on your particular farm, but the county might have a loss because other geographic areas of the county were impacted by some adverse weather event, and you can have a good crop and still collect an SCO payment if that happens. So you do have to remember that it is a little different than your underlying crop insurance product. I happen to like SCO, and I use it on our farm for basically all of our crops that are eligible to use SCO as a way to bump a little bit lower underlying basic insurance product with a lower premium up to a fairly high level of coverage in most years for a fairly low premium cost. But again, it's a good alternative, but it's not available to you if you have base acres of the specific crop you are planting enrolled in the ARC program, and that of course is the case for many of our wheat producers in Oklahoma. I'll turn it over to Trent to cover NAP for the crops that are not eligible for basic or traditional crop insurance product.
All right, I'll finish up here pretty quickly. Just a quick overview of NAP. Most of what I'm going to talk about in these slides is available at the fact sheet that it's at the bottom of this slide, the USDA 2014 Farm Bill fact sheets for the non-insured crop disaster assistance program. And it's basically what it says. You know, if you are producing crops that do not have, you know, available crop insurance policies, this is an option to cover some of your risk, and you may find producers or yourself in a situation where you have a crop that is not available or eligible for crop insurance, and you can cover some of your losses through this program. But it's going to cover natural disasters that result in either lower yields or crop losses, and or sometimes prevented crop planting. So what crops are eligible? Again, we said it's crops that don't have crop insurance available for them. And we can go over here to this other slide that has the eligible crop descriptions. The crops grown for food, crops planted and grown for livestock consumption, such as grain and forage crops, including native forage, which is one of the big uses of this crop or the insurance program, basically, is for our producers who are growing forage for animals. And then we have crops grown for fiber, such as cotton or flax. And then we have the mushrooms and floriculture or specialty crops like honey and maple syrup. And then, of course, crops grown for the feedstock. So again, quite a few different crops here. It differs by county. So it's going to be one of those situations where if you can't get a standard crop insurance policy, definitely go talk to your FSA office and see what types of options they'll have for those crops that you're looking to grow. Coverage levels are kind of similar to crop insurance, whereas the standard NAP coverage is a catastrophic level coverage, which will pay when losses exceed 50% of expected production, but it will only pay at 50% or 55% of the average market price. What's good for producers who need a little more coverage is additional levels of NAP are available to be purchased from 50 to 65% of production and up to 100% of the average market price, but that's going to result in a separate premium. So you have to be careful about, you know, really determining, like we've talked about before, how much coverage you need and the ability of these insurance programs or these different programs through FSA to provide you the type of coverage that you need. So applying for coverage is, like I said, it's done through the FSA office, and you have to fill out a form CCC-471, which is the application for that NAP coverage. And we have to have service fees paid before the coverage is available, and the closing dates vary by crop. So again, if you think that you may be interested in this coverage, talk to FSA sooner rather than later, because you would hate to miss those closing dates, and they change, and depending on where you are and what types of crops you're looking to insure. So again, get in contact with your FSA office in order to determine your eligibility and the opportunity to produce or purchase those different disaster assistance programs. All right, so in conclusion, and Dr. Jones will help me on the next slide here, talking about kind of the way we feel we should wrap this thing up. We have low prices and low profitability offer an opportunity for good managers to excel. And I keep driving this home with the producers that I talk to. This isn't the end of the world or anything for most of our producers. It's just a setback, and we've been having meetings on ways producers can reduce their fixed costs, reduce their variable costs, and spend money in ways that they can increase their yields in the best way possible. And by doing that, we really trim the fat off of our operations, and we get down to a point where we know what our bare minimum variable costs are. And that's an important piece of information to know whenever you're purchasing crop insurance or looking at these other programs to cover your risks. So again, the crop insurance product selection choice is very complex. You can't just go down to the coffee shop and hear what your neighbors are purchasing and go make that work for your operation. I mean, it's definitely a decision that you need to spend some time on and sit down with a good agent that can talk to you about the different options and all the different riders that are available for crop insurance policies and really determine the best way to get the most coverage at the least amount of price. So, and then if you don't need high levels of coverage, which again, as Dr. Jones and I would both agree, that's a rare instance right now with the way prices are. There's several ways to obtain coverage at a low cost. You can, again, just lower your coverage levels. We can go to enterprise units and try to chase lower prices there. But again, really, we're all going to be at those higher levels of variable costs, which means many producers are going to be looking at these higher levels of coverage, trying to push above that 70 to 75%, in my opinion. And one of the good ways to do that would be through enterprise units. So it would definitely be something, if I'm not purchasing it already, I would talk to my insurance agent and discover the limitations and the opportunities that are available through that crop insurance policy. And Dr. Jones, if you have any other comments, I'd turn it over to you, but that's about all I have.
Thank you, Trent. And before I finish up with just a few comments on how to get to that higher level of coverage at a little bit lower cost, or at least some suggestions to think about, I do want to apologize. We should have mentioned at the very first of the webinar, most of you are familiar with this, but if you do have questions for us, please type them into the little chat text box down there in the lower right hand corner. Just type in your question and hit enter, and it will show up, and we'll try to answer that before we sign off here. So we will allow just a few minutes to see if any questions pop up after I finish. This is our last slide. But again, in conclusion, in order to get to that higher level of coverage, as Trent mentioned, enterprise unit structure provides one way to get to a higher level of overall coverage for your entire crop, not for each individual field, and keep that farmer paid premium down a little bit. But some don't like the additional risk that's involved. Some don't. Some just can't handle the fact that we might have a total loss on a particular field and not get an insurance payment. So again, that gets a little bit more into your individual psychology, your individual views on what it is you're actually insuring. Another way to get to a higher level of crop insurance coverage is to use a lower level of underlying crop insurance coverage, which would be at a much lower and much higher subsidized premium level, and combine that with an SCO policy that brings that coverage kind of up to the 86% level. But as I mentioned, it's not exactly the same coverage because SCO triggers off of county loss rather than individual loss. But it's another strategy to think about to keep that overall farmer paid premium down while getting a fairly high level of coverage. But again, if you have crops that are enrolled in the ARC program, you just absolutely can't use that option because it's not available to you. Why they did that, why they added that level of complexity to the Farm Bill crop insurance decision, don't ask me. It wasn't my idea, but they did, and it's what we're living with. Robert is asking, can we recommend something to read for a basic understanding of crop insurance options, crop insurance alternatives, down there in the text box? And Robert, yes, I'll have to do some digging, and we will try to link to that on our website. But there are some very good simple readings that come out of both the Risk Management Agency that are available on their website, as well as the National Crop Insurance Services office out of Kansas City, NCIS, not the NCIS that we see on TV where they solve crimes, but the National Crop Insurance Services office also has some good basic level information that's not a terribly hard read, to give people who aren't familiar with the basic crop insurance products a good understanding. And we'll try to link to some of those resources on our website and send out an email to the group. Damona is mentioning that we on that website we already have some links to some resources put out by OSU, FSA, and links to some RMA publications. I know there's some others that we need to get linked there. Trent put in the chat box, don't forget to fill out our very brief survey pertaining to this particular webinar. The link to that is there in the chat box, so we would ask you to please fill that out. Any other questions?
Kevin, I would say that fact sheet that I mentioned when I was talking about NAP is pretty good at detailing the types of things that you're going to be able to find on NAP, and I'll see if we can back up the presentation here. Okay, so it's that USDA 2014 Farm Bill fact sheet, the Non-Insured Crop Disaster Assistance Program. You can Google that, and it'll come up, and that's a pretty decent read. But really, the best way would be to go to your FSA office, your local office, and to get more detailed information about your area, because that program has a lot of variability depending on where you are and what's available for coverage.
Again, Damona is mentioning that particular fact sheet that Trent referred to in the presentation and just talked about is also directly linked on that e-farm management website that we're trying to base a lot of this type of information on there. Again, don't forget the survey. We would really appreciate it if you would click on that link and fill out the survey.
Thank you, Dr. Jones and Trent. I wanted to also remind everyone that our next webinar will be a week from today, August 15th, and in that webinar, Dr. Eric DeVeest will demonstrate some of the decision tools that OSU has developed. So thank you, everyone, for watching our webinar. Have a nice day.